Hello and welcome to another video on Ind AS from GJ Management Consultants. So today we are here to present on Ind AS 27, which is separate financial statements. So the topics that we are going to cover today is objective and the scope. When are the separate financial statements prepared? And what is the definition of separate financial statements? What is the treatment of the dividend? What is the treatment when there is a condition wherein we have to do the impairment of the investment? What is the impact of the changes in the accounting method? Relationship with another Ind AS and disclosure. And then finally, we'll spend some time in understanding the differences with the IAS 27. So with this, we'll just quickly move to the first slide. Okay, so we'll quickly talk about the objective and scope of Ind AS 27. So objective is Ind AS 27 prescribe the accounting and disclosure of investment in subsidiaries, associates, and joint venture. So which means when an entity has investment in a company in which entity has the control, which is the subsidiary, or entity has the substantial interest, which can be in the form of the associate or joint venture. So subsidiaries we are going to cover in Ind AS 110. Associates and joint venture will be covered in Ind AS 28 separately. We will touch base each of the specific attributes with respect to subsidiary and associates and joint venture in the respective Ind AS. But in this section, in this particular Ind AS, objective is to understand that when is the SFS, which is like standalone financial statements, are required. So that are required if an entity is having the investment in subsidiaries, associates or joint venture only when entity prepares the separate financial statement. So which means that there is an obligation on the entity to prepare the separate financial statement. And this standard prescribe how the investment in subsidiaries, associates and joint venture will be accounted for when the entity is required to prepare the separate financial statement. So this Ind AS does not deal with the consolidation. Consolidation is covered in Ind AS 110. For the purpose of scope, applies to accounting of the investment in subsidiaries, joint venture and associate when an entity elects or is required by the law to prepare a separate. So which means that this SFS, which is standalone financial statement, is applicable to disclose the account, to disclose and to also mention the accounting for the entity if that entity has control in the other company, which is a subsidiary, or substantial interest in the other company in the form of the joint venture or associate. It requires how the accounting and disclosure of the investment is done, and if at all it is necessary for that entity to prepare the standalone financial statement, then it is required. But if there is no compulsion, then there is no requirement for this SFS. In that case, the entity, the parent entity or the entity, if it has control over the investee, which is in the form of substantial interest or by way of control in form of the subsidiary, then it has to prepare the consolidated financial statements. So we'll quickly move to the next slide to understand the definition and the purpose of SFS, which is the standalone financial statement. Okay, so when SFS are prepared, so an entity is to required to present the SFS in addition to the consolidated financial statement. An entity chooses to present SFS in addition to the consolidated financial. So basically, if entity wants that, it wants to show separate financial statement over and above the CFS, which is the consolidated financial statement, then entity has to adopt this method, and that choice is either voluntarily or if it is required by regulators, lenders, local laws, or the shareholders. So if there's specific requirement, then definitely they have to prepare the standalone financial statement, in which case the investment in the associate subsidiaries and joint venture should be shown as per the Ind AS 27. So SFAs are in addition as not substitute to the CFS. So which means that except exemption under Ind AS 110. So which means that there are certain exemption which is here in which are there in Ind AS 110, in which case if entity prepares the SFS, then it does not require to prepare the CFS. Otherwise, apart from those exceptions, in AS 27, which is like SFS, is not a substitute to the CFS, which is the consolidated financial statement. So parent need not to prepare CFS if all the following conditions satisfy. So which means that if parent is preparing the SFS and if it follows the below condition, then it does not require to prepare the CFS. And what are those conditions? Wholly owned subsidiary or partial subsidiary and other owner do not object. So which means that the other owner does not object the publishing of the of this SFS alone and do not require the CFS. Parent is not listed, no equity or debt is listed. Parent is not process of listing, no IPO plans. Ultimate or intermediate parent prepare the CFS. Those CFS are Ind AS compliant date and are available. So which means that if these conditions are satisfied, then in that case, parent do not required to prepare the CFS, which is required as per the definition of Ind AS 110. If they can prepare the SFS, then it is sufficient. So which means that consolidation is not required if at all these conditions are satisfied. What are those conditions? Parent is not listed, parent is not in the process of listing, wholly owned or partly owned subsidiary, if and only if, and other owners which do not object for the preparation of the preparation of the financial statement on SFS basis rather than CFS basis. So if conditions are satisfied, then presentation by the parent of SFS is sufficient and it does then they are not required to produce the CFS, which is the consolidated financial statement. But if at all an entity chooses to prepare the SFS, then it has to follow the methodology which is being prescribed in the Ind AS 27. So we'll move to the next slide then. Okay, so what are SFS? So, separate FS are those in which investments in subsidiaries, associates, and joint venture are not consolidated. Investment are shown as a single line item. So, which means that the consolidation which is required and prescribed as per Ind AS 28 for associates and joint venture and Ind AS 110 for subsidiary is not required. Investment has to be shown as a single line and then it has to be recognized at a particular uh, as per the particular method. And what is that method? We are going to have a look at the details. So performance of the investment is not merged line by line. In separate financial statement, investment in subsidiaries, associates, and joint venture must be accounted using one of the methods. So what are those methods of recognition? First is at a cost. Second is at a fair value as per the Ind AS 109. So there are two methods. They can be accounted at a cost or they can be accounted at a fair value. Either of this is adopted. Equity method is not prescribed for the SFS. Equity method is prescribed logically in a consolidation, in a CFS. So same investment in subsidiaries, associate, and joint venture in the CFS, it will be accounted for in the equity method. But when we come to the SFS, for the same investment, it has to be accounted for either at the cost or at the fair value as per the Ind AS 109. So, which means that two methods are permitted. Option one is the cost method, and second one is the fair value method. So we'll move to the next slide. And if we try to compare this with the IAS 27, it is absolutely same. There is no gap or no deviation with the IAS 27. So important point to remember is that in SFS, the investment in subsidiaries, joint venture and associates needs to be accounted for either of cost or the fair value. Equity method is not allowed, but same investment in subsidiary, joint venture and associates will be required to be disclosed in equity method if at all we are preparing the CFS and not the SFS. So SFS only choice is there between the cost method or the fair value method. So we'll move to the next slide then. Okay, so we'll quickly have a look at the example here to understand a bit more in terms of the accounting and the recognition of investment in SFS. Okay, so we are saying that in option one, which is like cost method, company A invests 10 crore in subsidiary B. Initial recognition would be at 10 lakh, 10 crore, which is the investment that we have done. Subsequent accounting investment remains at the cost. Dividend received will be recognized in P&L. Simple. No adjustment for subsequent profit. So which means that uh, in normal scenario wherein there is an investment in a subsidiary and if it has to be CFS, separate method is required. But in the SFS, we have to simply keep two things in mind that investment should be measured at a cost. If it is company has chosen the accounting option one, which is like measurement at the cost, and then after that there is no changes to the investment. Whatever dividend will be received, it will be credited to my P&L. But if it is a fair value method, which is Ind AS 109 example, investment in JV is recorded at fair value to OCI. cost of investment is 5 crore, fair value is 5.5 crore at the end. So whatever increase in the fair value, that will be accounted by investment in JV, and credit will be to my OCI. So these are like two methods to recognize the investment in the subsidiaries, joint venture and associate, and then how subsequent accounting will happen. So for cost model, there is no subsequent impact on the investment in the cost, but whatever dividend would be received in the future, that will be credited to my P&L. But for fair value, whatever investments are there, if it has to be, if there's an increase in the value of the investment, that investment increase value needs to be recognized to my OCI. So we'll move to the next slide then. Okay. Now we quickly talk about the dividend, though we have spoken about this in the last slide. So let's just quickly have a look. So dividend from subsidiary associate JVs are recognized in the P&L only when right to receive it established and not be adjusted against the investment cost. This is most important because this is SFS. In the CFS, and when we were using when we are going to use the equity method, then in that case the dividend received will be adjusted against the value of the investment. But in SFS, there is no adjustment required. It will be treated as an income and shown as my credit to my P&L. This is most important point that we need to keep in mind. And most importantly, it has to be recognized only when the right to receive is established. And there is no deviation. IAS 27 also aligned with that. So we'll move to the next slide then. Okay, now we'll quickly talk about the impairment of the investment. What is the treatment of the impairment of the investment in my SFS? So investment measured at cost should be tested for impairment, most importantly, because for fair value, it has to be always recognized as the fair value. So whatever movement in the fair value, that will be recognized through my OCI. But specifically for the cost, whenever it is a measured cost, it has to be tested for the impairment, which is governed by Ind AS 36. Impairment loss will be charged to my P&L. So this is SFS. So in case of SFS, in case when their investment model is measurement at cost, and in that case it has to be tested for impairment. If it has a fair value, then there is no requirement because any adjustment in the fair value anyways will be managed to my OCI, so upward or downward both. Now when it is measured at cost, it has to be tested for impairment. Impairment testing will be as per the Ind AS 36. Any impairment loss would be recognized in my P&L. For example, if I have a carrying amount of investment as 10 crore, carrying amount reduces to 7 crore, there's an impairment loss. Now we have to debit my impairment loss to P&L, and we have to decrease our investment in associate, joint venture or subsidiary, whatever the case may be, by appropriate, by the same amount. And if we try to compare this with the IAS 27, it is absolutely aligned and there is no gap. So we'll move to the next slide then. Okay. Now we'll quickly talk about the changes in the accounting method. So which means that if entity wants to change the method from the cost to fair value or vice versa, then what is the impact? So if at all it is a change in the accounting method, this is treated as the change in the accounting policy because it has the direct impact on impacting the value at which accounting is to be happen. Definitely it's a change in the accounting policy itself because recognition criteria itself is going to get changed, and hence it will be governed by Ind AS 8. And in that case, there has to be a retrospective applicability except in the case of the impracticability. So which means all the concept of Ind AS 8 which requires the retrospective presentation, it has to be showcased for those changes in the financial statements, and necessary disclosures are also required. And this is absolutely in line with the IAS 27. So we'll move to the next slide then. Okay. So we'll quickly try to link this Ind AS 27 with some of the AS which Ind AS which is very closely aligned with the financial representation and the financial statements. Consolidation, which is Ind AS 110. So which means that in Ind AS 110, which is very closely associated with the CFS, which require the rules and methods and the ways it has to present in CFS. So Ind AS 27 is a bit different from that with respect to the method in which accounting statements, the investment in the associate, subsidiary, or joint venture need to be presented. So it has a very close link with the Ind AS 28, which is like investment in associates and joint venture financial instrument, because in AS 27 prescribe the two method. One method is cost and second is the fair value as per Ind AS 109. impairment Ind AS 36 and definitely disclosure, which is my related party disclosure. So related party disclosure is again same. I mean, it does not the impact or the disclosures of Ind AS 24 does not uh, in any ways reduced because we are preparing the SFS. So all those disclosure which are required to be done as per Ind AS 24 will still be required in my SFS as well. So this is absolutely aligned with Ind AS 27. So we'll move to the last slide of this Ind AS 27, which is the comparative analysis between the IAS 27 and Ind AS 27. So we'll move to the next slide then. Okay, so we'll have a look at the disclosure and the comparatives. So when we're talking about the disclosure, so what needs to be disclosed as a part of Ind AS 27? So nature of the relationship with the subsidiary associate or joint venture, nature of the relationship, and then a list of the significant investments that has been done, and then a reason for preparing the SFS if it's in addition to the CFS. All these needs to be disclosed in my notes to the accounts, and then we try to compare the Ind AS 27 is IAS 27. Objective is same, accounting options are same, equity method again not allowed, dividend treatment is same, impairment is same, and disclosure is also same. So there is no gap with IAS 27. This is the last slide. We'll quickly move to the final slide, which is the thank you slide. Okay, so this is the thank you slide. So as usual, I would like to thank all my viewers and subscribers for watching this video till the end. And it is our continuous endeavor to bring up, refresher on the in AS and a request to all my viewers and subscribers is to please cascade this to as many users as you feel would get benefited from these refresher series, and they can also get understanding if at all they are working professional. This was very useful for them as well. So we are going to come up with the new Ind AS very soon. Till then, have a good day and bye bye.